Good afternoon, everybody. Sound check, how's the sound? It's exactly 5 o'clock on the east coast of the United States and a few other select locations. How is everybody doing? Everybody gave a nice warm good afternoon. Hello. And we will get started on time as always. I have a 99.94% on time ratio. All right, we're going to get right to it tonight. I don't think this might even last the whole hour. I don't know. I sent you a little comment. Sometimes I put a comment out mid-afternoon just to kind of alert you to what it is. I know we all love these thrilling chart-filled, trade-filled presentations, which a lot of them have been lately, quite honestly. This one is not really going to be that, but I think it's a very necessary one to do because this is a career saver, an account saver, whatever you want to call it. But I picked a handful of things. I had five. I actually brought it down to four because I think I talked about one of the others not that long ago. And these are things that I guess it doesn't amaze me, but I think I'm a little complacent in not realizing how much these things still affect people. One of them, the first one we're going to talk about, I do go over in the seminar program briefly at the end of one of the classes. And I mentioned one time that I was maybe going to stop discussing it because I wasn't sure, that it was worth the time. And I got, even from the seminar group, I got several emails saying, don't stop talking about that. That really hurt me in my past. People who don't normally would speak up, but when I said, hey, maybe I don't need to keep going over this, they spoke up and said, yeah, that I killed an account with that. So please continue to warn people about this. So we're going to go over those, and I picked out four things that are the don't do's for tonight. We can go to this first slide here because you've already seen it. So I did send you an email saying this is not going to be spectacular. There's not, charts and stuff in it, but I think it's some very, very important topics. And the first one here is probably the one that's going to take maybe a third of the time of all of them because I continue to see how important it is. And I actually saw somebody a couple of times now has emailed me a YouTube video from somebody actually practicing this first one. So we're going to go over that. There are many conceptual topics. So what I mean by that is there are things that can hurt you in terms of just strategically being wrong, but those are not always terrible because you kind of learn. You do the wrong thing on a chart, everybody does that. But these are more conceptual concepts. These are more bigger picture concepts, things that can actually, ruin your career. So the first one I want to talk about here is this distinction right here. I want to get all the terms out there first, and then we're going to talk about this. Why is it that these things are even an issue? Well, these are an issue because I think out of trader frustration. I don't think anybody in the right mind would actually, looking at objectively, really try to do one of these things or to do what I'm going to discuss, in the wrong way. But traders go out and they get frustrated. They try to learn to trade. They start losing a little money. They're usually not very well educated, so they're not sure what to do. And they turn to kind of alternative methods out of desperation. I think desperation is the reason some of these things happen. And this first one here is particularly pertinent for right now because of what's going on in the bigger marketplace and because whether it's day trading or long term, everything I'm talking about applies to both here. But whether you're day trading and do this thing called averaging down, or whether you are long term, where it's even more likely and more common you're going to average down, it can be very, very deadly to you. So let's take a look at this. I want to tell you, here's the three terms. There's averaging up, averaging into, and averaging down. Those are the three terms that we have here. And you can tell by the little smiley faces, averaging up is the correct way to do things. I'll mention that toward the end. We're not going to review how to do it necessarily, but that's the right way to do things. Averaging into can be okay. I'll talk about that distinction. The sin here in trading is averaging down, and I want to get into and make sure you understand exactly what it is and why it's tricky and why somebody could show you that this is almost a guaranteed way to make money and what the trick is so that you don't ever fall victim to it. So I'm going to give you a quick story. It's a fun little story. I like it, and it really makes the point, and a lot of people have commented they really like this story because they didn't realize how the math works in this. I always say there's a lot of math in trading. So that's me sitting on the couch there. It doesn't really look like me. That guy on the slide is way too handsome, but the point I want to make is this. I am sitting on the couch one day, And my wife tells me, and by the way, my wife is very strict, and she tells me that, and I'm not allowed to carry any money because she controls all the money. I have a credit card, but I can't even use it because if I used it, she'd get the statement and she would kill me, of course. I'm not allowed to carry any money in my pocket. I'm joking, of course, but just to make this story, my wife is actually quite wonderful, isn't she? She's not here. Okay. So I'm sitting on the couch and she comes by and says, "Hey, here's $100. And here's a grocery list. I'd like you to go buy these groceries. I'm going to go out shopping for some clothes or something." I say, "Okay, I don't mind. I don't mind doing that stuff. That's fine." So I'm sitting there thinking, all right, $100. I got to go get groceries sometime this afternoon while she's out. But then the phone rings and it's my friend who is down at the golf course and says, "Hey, I have a tee off time for 2 hours. Are you in?" And now I have this problem. Golf's going to cost $100. Groceries cost $100. I only have $100 that my wife gave me. I have no way to get any other money. So I have a little dilemma. So I tell him I'll call him back. So I sit there thinking about it for a couple of minutes, and then I decide, you know what? I give him a call and I say, "I'm going to golf, but do me a favor. There's a casino across the street from the golf course. Meet me there in an hour, and we're going to be golfing." "Okay," he says. So I meet him at the casino. Now, on the way to the casino, though, as I'm driving there, you have to give me a little slack for this part of the story. As I'm driving there, I pull into the bank, to my bank, and I happen to know the cashier there, neighbor of mine. And I say to her, "Hey, here's what I'd like you to do. Here's my credit card. I'd like to get a $3,200 cash advance, $3,200 precisely. But please don't charge it on my card yet because my wife will kill me. I'd just like you to give me the money. I'll bring it back in a half an hour." And she knows me. She says, "Okay, I'm going to keep your card. If I don't see it, we have to charge you." I said, "I know, that's fine." So I take the $3,200, I put it in my pocket, and I leave. So now I have $3,200 in one pocket, and I have $100 my wife gave me in the other pocket. Everybody following me. And my goal is to double my $100. My goal is to double my $100. Everybody follow this story so far. Everybody follow this. If you just turned in, you probably think you tuned into the wrong presentation, okay? I get to the casino, $100 in one pocket, $3,200 in another pocket. I have one and only one goal, and that is to double my initial $100. Because remember, I have to return the $3,200 to the bank. So I can't use that because if I used any of that, my wife would kill me. So I have to double that initial $100. Now, just for blackjack, you may or may not understand. It's not like I play blackjack. I haven't played blackjack in years and years and years and years. But anybody know what's the odds of winning a hand of blackjack if you just know the rules, basically? If you just follow the basic rules, the little manual they give you when you walk in, what are the odds of winning a hand of blackjack for you, the patron, the client, the sucker? What are the odds? I hope I'm still accurate in my, well, that would never change. Yeah, so the odds of you winning one hand of blackjack are 48%, correct? I'm sure there's some real blackjack players out there. That's just a mathematical thing that really doesn't change over time. So for this presentation, I would like to make the math simple. You could do it at 48%, but I would just like to say, for this very limited sample we're going to do here for the math, let's just say it's 50%, okay? Flip of a coin. And so I'm actually increasing my odds 2%, but 50%, okay? Close enough. It's not going to affect the point that I'm trying to make here, all right? So I walk in and I have $3,200 in one pocket, $100 in the other pocket. And my question for you is, what are the odds of doubling my $100? Give me some numbers. Go ahead. What are the odds of me accomplishing my job? Doubling the $100 so I can buy the groceries, golf, return the money to the bank, and have just a happy afternoon. Happy wife, happy day golfing. Well, I probably wouldn't be happy golfing, but what are the odds I can do it? Go ahead. Go. Numbers. What are the odds? Van comes up with a very intuitive, sharp answer initially, 50%. Because Van, you're saying, I walk in, right? I take that $100, I put it on a hand of blackjack, and if I win, I'm golden, right? I'm out of there, right? Right, Van? I'm done. That's all I have to do. But it's 50-50. What if I lose that hand, Van? You know what it's like having an unhappy wife? I can't take the chance of a flip of a coin losing that hand. And why do I have $3,200 in my right pocket if all I'm going to do is just take that 50-50 chance on my life? Why do I have that? Anybody want to give you some different odds? Anybody have a different take on what my odds are of doubling $100 under the scenario I gave you? And by the way, Van, your answer is so common and intuitive. I put it there. See, obviously these slides were done ahead of time. 50% is a very common guess. Is that the best I can do, though? Is that it? Still 50% no matter how many times I flipping a coin. Okay. Mukesh. Mukesh has a crazy comment. Over 90%? You think I can double my money 90% of the time? Actually, you're not even quite there. The answer is 97%. 97%. You're right, Mike. On any single coin flip is 50%. However, what are the odds that X number of coin flips will all come up heads, right? Van, you're funny because you know what it says on the next thing. Well, let me explain to you how you do it. I bet the $100. If I win, I'm done. I get up and leave, right? What if I lose? Well, I double my bet. I bet $200. If I win the second bet, I'm up 100. I'm out of there. If I lose, now I bet $400. If I win, I was down 300. If I bet 4 and I win, I'm up 100. I'm out of there. Now I'm down 7. I bet 8. If I win, I'm out of there. If I lose that one, I'm down $1,500. I have to bet $1,600, and you'll notice that I'm now out of money in my right pocket. If I lose the $1,600, then I get in my car and I drive to the West Coast and don't stop until I get there. But if I win that last one, I'm golden, right? So in other words, I have 1, 2, 3, 4, 5 chances. In other words, look at it this way. I would have to lose 5 hands in a row to bust. Everybody follow this? What are the odds of flipping a coin heads 5 times in a row? Well, I do apologize for bringing in hard math, and probability statistics is not my favorite class. No, Mike. No, flipping 5 times, right, exactly, Steve. It's 1 times 2 to the 5th. Any one flip is 50-50, but if you were to take a set of 5 and to say, hey, here's my bet. You flip that coin and you flip it 5 times in a row heads, that's only going to happen 1 in 32 times. 1 in 32. Which happens to come out to 3.1%, which means, ipso facto, that you can walk into a casino, you have a 7% chance of not losing 5 hands in a row, assuming you had 50% odds. It's actually 48, so it'd just be a slightly bit off from that. And that means that as long as you win one of those 5 hands, you win $100, right? Mike, let me finish. I'm not here to tell you to quit your day job and to quit trading and to go to the casino, right? As a matter of fact, look at this next slide. Look what it says. So that means 97% of the time you can double your money. And by the way, this is true. There is no falsehood about that statement. I need you to understand that. It is true, right? Casino players, it is true. You can do that 97% of the time. What a system. But before you quit your day job, this is simply called the martingale system of betting. It simply means that statistically you will win $100 on 31 visits. And then on the 32nd visit, you will lose $3,100. That's all it means. And that, of course, is what is scary. So it means that you have absolutely no edge. If you were to flip a coin and say that's what you're betting on all day long, you would just break even at the end of 1,000,000 flips, right? Well, if you use a martingale system of betting, you're also going to break even at the end of 1,000,000 trips to the table. It's just that what you've done is you've kind of skewed the setup, if you will, okay? What you did was you skewed the risk reward to the chances of winning, right? You did nothing to change the odds of winning overall, in the big picture, winning money. What you did is you took the chance of winning, your batting average, and you said, I can make money 31 out of 32 days, but your Sharpe ratio, if you will, your average loss is going to be $3,100. The point is that you can actually do that. Now, my next question for you is, can you make money at blackjack using this martingale system? Could you do that? Can you do that? Even though theoretically you would break even after a period of time. Well, not in the short term. Well, yeah, you could any one day, Chris, you could say, oh, I'm going to the casino, get lucky, but it's going to catch up with you one day, right? But actually, I mean, you could. You could, if you were to ask a computer, hey, how many times in a row can a coin come up heads and get to a number where I just feel safe? Like I'd risk my life, a 1 in a 10 million shot. And whatever that number is, if you came in with enough of a bankroll, you could say go to make $500 and have $5 million in your pocket. And you can't lose infinite hands. Sometime you have to win. And if you felt good that the number was, that you're playing odds at 1 in 10 million, it wouldn't happen to you. You would take your $1 million and go win $500 at a time. But guess what? They prevent that. Do you know how they prevent that? David knows. They prevent that because that's exactly why there's a table limit. So that when you double, 2, 3, there's a minimum, there's a maximum. How many times can you double $10 before you're at 1,000? Not that much. So you hit that max and you can't get your money back. And boy, casinos would love somebody to be betting $1,000 to get $10 back. That's what they would just love. So the table limit is what stops you, and you have your own table limit, right? Oh, right, Mike, exactly. And that's the question you're talking about that Douglas talks about, right, which is true. You have no greater odds of winning the next hand. And that actually goes back to that book, Trading Your Way to Financial Freedom by Van Tharp, the monkeys pulling the slot machine analogy, which I really love. It is Sam's Clams Casino. I didn't even know that was it. I just pulled the first image I could find that had a table limit on it. So how does this work in trading? Well, how it works in trading is that people have this idea and they get caught in it sometimes, and sometimes they're actually trained this. That you buy 500 shares of some stock, and when it stops and you're at your loss limit, they say, well, instead of getting out of this, I'm sure it's going to come back, so I'm going to double down. I'm going to buy 1,000 more shares. And if it keeps going down, I'm going to buy 2,000 more shares. And by averaging down, you're keeping your average cost very close to the current price so that any little pop in the stock will have you making a little bit of money. Is this a good way to make money? Is this a good way to make money? By averaging down and keeping your costs very low. Now, it's not only not a good way to make money, there's two issues here. Number one, some people accidentally do this. I'll talk about it. But believe it or not, this is actually taught sometimes. And this is the point that I was making in seminar classes where people said to me, Paul, please don't ever stop pushing this because they got caught in this. You could go watch somebody trade live and they'll sit there and say, I make money every day. I make money every day. And the key is that they're never telling you what they're risking nor what their goal is to make. So they just buy more shares, this is dropping, buy more shares, and all of a sudden the stock pops, boom, boom, boom. They made some money and they're done. It sounds great, but I want you to understand it's exactly like at the casino table. Sure, he can sit there and make money 20 days in a row, and then all of a sudden, boom. The problem here is when you lose that next time, your account is gone because it adds up very, very quickly. I've had 2 or 3 videos sent to me when I've talked about this because there's some people out there that actually train this. It's on YouTube. If you Google YouTube, I don't know what the title is you look for, but somebody sent me one where the title of it was How I Made $800 Day Trading Today. At first I thought it was a parody. I thought this guy was being funny, but he was serious. And when you watch the video, if he would have had to double down one more time, he would have been risking $20-some thousand to make 800. And this is just kind of a normal stock, nothing crazy. But the point is that when you do this, you will get one of these stocks one morning. There's going to be a stock that, doesn't come back. And it's not going to be every day. You'll make money most days. But when it doesn't come back, you're done. You're gone. You're through. You're finished, right? This is the treacherous part of this is that it kind of works. I just showed you it worked. I just said, hey, you can go to the casino and double your money any day you want to. Well, not any day, but 31 out of 32 days you could, right? Well, Van, I don't care if it's dividend stocks or not. I mean, dividend stocks fall, and if they fall, you're going to be out of money. So you just absolutely cannot do this. And this is the statement I want you to remember because it's just absolutely true. If you average down trading, you will go broke. It's not a question of if, it's a question of when. You will go broke averaging down. Don't ever do this, okay? Don't ever do this. I've had more people than I could believe that have told me that they got slaughtered doing this at some point, right? Part of me says, well, okay, I think most people know this, and is that really that big a deal? And every time I kind of lay off it, people are like, yeah, it is a big deal. I've really been hurt by this before. And here's the other way how it really hurts people. Well, I'll get to that in 1 second there. So averaging down, no, ultimate sin. Averaging up is the professional way to do it. You use your profits from the trade to add more shares. And you can average into something, and that's just a little bit different. Averaging into would involve buying lower. It means you buy shares, and you buy such a small amount that your stop would be way down here somewhere, meaning the amount of money you're willing to lose. And then maybe down here you add some shares. So you do buy them at a lower cost. I don't want to use that term. You buy them at a lower cost, but you're averaging into it. And then when you do that, your stop has to come up to here. And then maybe the stock makes one more bounce and you buy some more shares, and then you bring your stop up to there. So maybe you were able to lower your cost, but that entire time, at any moment the stock dropped, you're going to get out for a fixed loss amount, not infinite, because averaging down leads you to an infinite loss amount. All right? Right. Well, let me ask this question just for fun, because I wrote this down when I was sitting here waiting to talk to you guys. Lope, is it okay to be loose with your stops? And I'm just going to leave it phrased like that. Is it okay to be loose with your stops? What do you guys think? Is it okay to be loose with your stops? Any other comments? Let me get a couple more comments. Is it okay to be loose with your stops? I like the way I phrased that. Just leave it a little vague. Is it okay to be loose with your stops? Depending upon, obviously, there are some people who know me very well, and there are some people that may be shocked by my answer. Well, you take a trade, you have a stop. You said that's what I sized it to, whatever, and I'm assuming that at your stop, you're at your full risk. Is it okay to be loose with your stop even when you're at full risk? Being loose with your stops, and be real careful here. I'm going to put asterisks all over the place. But being loose with your stops can be one of the most profitable things you ever do. Now, notice the difference in wording. You need to be rigid. You need to be rigid with your money management. There's a difference, okay? But being loose with your stops may make you more money than you would ever believe. As a matter of fact, when people start off trading, they often go broke because they don't follow their stops. When people get better, they still don't succeed because they do follow their stops. And some of you, maybe that hits home with you a little bit. There's a way in between to do that, and it's all a matter of tracking. But you absolutely have to have a hard stop somewhere. That's what money management is. But in terms of what your chart originally said, there's a lot to be learned, a lot of money to be made from understanding that properly, right? Well, I just want to throw that out there because somebody mentioned it. So you have to be rigid in your money management, but not necessarily in your exact chart stop all the time. It depends on your trading style, and you may find it to be a very profitable thing. It's something I talk a lot about. But so that's averaging too. And what I want you to be real careful of, and I would have never even thought to include something like this, except somebody emailed me, and it's funny because we're right in this period of time right now, and they said, this is a while ago, but during a prior slide, but they said, I know you're not supposed to average down. I know that's bad, but we had that first dip. He called it a dip, of course. It was not a dip. It was a downtrend, and I bought XYZ stock. And when we dropped some more, I didn't add to the stock. Guess what he did? And again, this is where, in my mind, sometimes I think I'm a little disjointed from the average trader or a new trader. I feel like I'm very in tune with new traders, but sometimes I'm like, what did this person do? When we dropped more, so I was not going to buy more Microsoft. I'm not averaging down. I know not to do that. But what did the person do? Yeah, exactly, Eric. Bought Zoom on the next little bounce, and then we went lower again. Bought Intel, whatever stock. I'm making up the stocks, but bought 4, 5, 6, 7, 8 different stocks. And they were done. I mean, they were just done. I mean, their account was basically 2/3 underwater. And then of course they asked to write, what should I do? Well, it doesn't matter much what you do now, just kill everything and save what money you have. But it's the same thing. I mean, this is the same concept of averaging down. It's just that you're doing it through different stocks instead of doing it all in one stock. All right. Are there any questions on this one? And this is one of the, if you saw the slide at the beginning, I didn't focus on it, but it said importance high, and then this is the next one, but the last one said importance high. It's not something that maybe applies to everybody. Most people know this or figure it out or don't do it, but it's a very, very high importance thing because it completely wipes out people, wipes out their account. And the important thing I want to really emphasize about that as well is that when you are doing that, averaging down to some degree, have you done anything to increase your odds of the trade you're taking being successful? Have you done anything to increase your odds of the trade you're taking being successful. This is adding to a losing trade, Mike. Exactly. Yeah. Right. Well, adding to a losing trade without any money management involved, Mike. That's the key. Yeah. See, somebody asked the question back on the blackjack scenario, and I didn't want to get into it then, but they said, well, learn how to count cards. That's a whole different topic. See, counting cards increases your chance of success. Learning technical analysis increases your chance of success. It's an exact analogy there. So somebody who doesn't understand blackjack thinks, oh, I'll just bet in a martingale system. They don't win because they didn't increase their odds of winning. They just shifted the reward to risk and chance of winning on any given day. Same thing with the trader. Trader says, well, I don't want to learn technical analysis. I'll just do this betting style, this share sizing style. That means I'm going to make money most of the time. But no, you're not going to make money, and you didn't increase your chance of making money. Learn how to count cards, that's a good answer. That increases your chance. As a matter of fact, I understand that you can get over 50% if you know how to count cards. Obviously, you can. And same thing in trading. If you learn technical analysis, you get the odds in your favor so that if you use proper share sizing methods, you will make money. Yeah, as you know, that's my favorite trading movie, Mike. I don't know if you know that or not, but it's the one I tell traders to watch more than anything else. And it's on the other stuff page at DTS. And I suggest you watch the movie 21. It's kind of for a different reason. It has nothing to do with betting. It has to do with psychology. But if you go to the other stuff page, the movie 21, I suggest you rent it, watch it, and then come back and watch the clip that's on my website, which is a 2-minute clip, which is the purpose for which I think you should watch the movie in the first place. It has to do with psychology. When you've been through it, you can look at that clip on the site and go, yeah, you know what? That's never going to be me. It's never going to be me. Okay. So on to the next one. The next one is the general concept, and I'm not talking, this is a new topic. I'm not talking about averaging down in any way. I'm talking about just buying downtrends in general. Buying downtrends in general. There is a tremendous bullish bias for a lot of people. And even if you're kind of neutral, if you listen to the news, the pundits, whatever, you know, it's constantly this bullish bias being promoted all the time. And the whole way down this whole year, I heard it called the dip. You know, is this a buyable dip? It's always phrased the dip until we reach a certain level where the public kind of said, I'm not happy with this anymore. And they changed the wording, and now they're questioning, are we in a bear market or not? But it's very difficult for a lot of people to understand the difference. And again, this is one of these that's a very high importance because it's not a high degree of technical understanding you need to understand the difference between buying a dip in an uptrend and buying a downtrend. And I'm not here to teach that here tonight. It is an in-depth topic to some degree, but the basic parts of it are not rocket science. And when we shifted at the beginning of this year, we went into a downtrend, and none of the dips are buyable despite what idiots on TV say. So understanding that is critically important because if you buy the dips in a downtrend. Now understand, it's hard to say that you can't buy downtrends because you're always buying downtrends to some degree. In other words, if you buy this uptrend right through here, in a sense, if you looked at a smaller time frame, you actually were buying a downtrend on this time frame. You see what I'm saying? So you're always buying a downtrend somewhere, but the point is on your time frame of reference, you have to be in an uptrend, and that's what you have to be doing all the time. What you don't ever want to be doing is doing this, is buying those dips, those bounces, because those are the ones that are going to kill you. If you did that, you're holding shares that are now 20% underwater at this point. If you started doing this, well, at least the early shares are 20% underwater from the beginning of this year, or they were as much as 30% at one point. They're less than that now. A simple concept, many don't know when we are in downtrends, accounts are wiped out for not understanding this concept. So at this level, this is a very simple one. This is number 2 of the don't do list. And it's just simply the understanding of that you simply do not buy downtrends. If you don't know what that means, you kind of got to get the training to understand what that means. But we're not always in bull markets. And I want to remind you the 2001 dip took 17 years to get back to the prior highs. And I personally think this one's going to be a lot longer. So be very careful what you're doing. Make sure you know what you're doing. Get help to find out what you're doing, but don't just randomly get in a position where you're going to be underwater for a long, long time. All right, that was a simple one. That was number 2. On to number 3. I didn't know how to phrase this one exactly, but I called it importance medium. This is a structural concept. It can kill accounts. I think it's one of those things people do out of frustration. What do I mean by asking opinion? There's a very fine line here between trying to train yourself and asking opinions. I think it is silly to ask other people of your caliber their opinion on a stock or a market or whatever it is. You know, people that go into free trading rooms, free chat rooms, and they say, gee, what do you think of Zoom? Oh, I like it. What do you think of Intel? I had a caption here, and I erased it because I didn't want somebody just, glancing at the screen getting offended by it. But it said, idiots asking idiots is what it said. And I don't mean that for everyone who asks a question, so I took it off the screen. But I meant just people that, if you're going into a chat room of people you don't know and asking, what do you think of buying Intel here? Do you see what I'm saying? Maybe it doesn't offend you as much as me, but it's just like, what are you doing? I mean, you're asking people with less knowledge than you or the same. What's the point? I mean, you're bored, you're stupid. What are you doing, right, Mike? It's just a ridiculous thing. And yet chat rooms are filled with these. I don't think I logged in one in 2-3 years, but I mean, once in a while I'll just go in and see what people are saying just for the comic relief. And it's just like unbelievable. Everybody's asking, what do you think of this? What do you think of that? Well, what do you think about it? Who cares? Learn what you're doing. And I think this can become a crutch for people is why I hate it so much. It's like there's the human emotions we have, and one of them is that camaraderie thing. It's that lemming thing, right? It's like, well, if you buy Intel, I'll buy Intel. I'll feel better about it, right? Right, exactly. We need confirmation to make stupid trades. That's exactly right, Mike. So don't do this. I just want to point out how ridiculously stupid it is. Now, this also includes reading articles. Depends who writes it. There are some people that probably write some good stuff out there. But anybody on TV, you should be immediately assumed they're not there for your benefit, right? They're there for an ulterior motive. Warren Buffett is not on to give you guidance. He's on to encourage you to buy stuff so he can sell into you. When a fund manager comes on and says, oh, he thinks the market's going to go much higher, he doesn't think it's going higher. He's not stupid. He wants the public to buy so we can sell into that. Why would he tell the public to buy the market if he's still trying to buy the market, right? So remember, everybody's an ulterior motive. People who are paid to come on and do television commercials to sell you stuff, whether it's the ding-dongs that are selling gold or whether it's Born Identity, Jason, what's his name? Matt Damon. Matt Damon selling crypto. Did you notice something, guys? Did you notice that Matt Damon advertised crypto at the absolute top? Did anybody notice that? You know what I'm talking, right? The Matt Damon commercial? He does a cool commercial, right? Do you think that's a coincidence that Matt Damon got paid millions, I don't know what, to do a commercial, and that public rally formed the top in crypto that dropped for months now? Just a coincidence. So don't listen to these people. Nobody is there. Did Brady do it too? I'm going to do a whole video on this a little bit later this year about all the actors and paid spokespeople that are selling crap that they want to get rid of. I mean, and when I say it that way, obviously crypto's crypto, whatever it is. I happen to like crypto, but getting people to buy it at a point where they want to sell is my point. Okay? Yeah, exactly. Yeah, they all do. I know. Yeah, William Devane, yeah. I'm sure he's happy. Remember, Van, he loves the feel of gold. That's why he owns it. He likes to feel it in his fingers. That's what he said in that one commercial. Anyways, so what else on this one? Asking opinions. I mean, sometimes I get questions from people that got an email from somebody. I'm just like, I want to scream. I'm like, you shouldn't even have an account if you got an email from somebody you don't know saying you should buy this penny stock or whatever it is. I mean, there is zero. Let me give you a little personal insight to something. In my entire career, do you know how many times I've been offered inside information? I don't mean like truly inside, but I mean somebody who knows something and they know the stock's going here. Anybody want to take? I don't even know. I don't know the number, but it's a lot. It's a lot, right? People talk to me, they email me, do me a favor. Hey, Paul, I know this isn't how you trade, but my neighbor has an aunt who has a cousin who married the second person who oversaw the secretary in this office, and they're going to do this and that, right? Yeah, following Paul Pelosi, that I would do, yeah. But I'm going to share something with you. Twice in my entire life did I ever buy something based on that. Twice in my entire life. And neither one worked. Small amounts, no big deal. And I think any other one I ever followed, just out of curiosity, nothing ever worked. No tip. Does anybody know a tip that ever worked? Now, I don't mean if you had true inside information. If you actually do live next door to the vice president of General Motors or something great. But I mean, has anybody ever had a tip that worked? Ever in the history of the world? No, I would never give them either. Yeah. Here's a tip for you all. Don't follow tips. Wait a minute. Wait a minute. My brain is hurting. So there is no shortcut is what the bottom line to some of this stuff is. There is no shortcut. You just have to learn what you're doing. And to this extent, I'll just say whatever you want to learn. I don't care what it is, but whatever you want to learn for yourself what it is you want to do and follow yourself. Nobody's out there giving tips to help you to make money, right? Pros on TV, boom, boom, boom. And keep in mind, some of the people that you hear from and maybe write stuff, some of them may be people that you could respect. Like I've said before, some of the fund managers are no doubt intelligent, good traders, good technical people and that sort of thing. But they're not there helping you make money right now. They're there because they have $1 billion fund they have to worry about. And anything they say is a self-serving comment. They're not there to give you market advice or stock advice or anything else. Remember the famous line. Remember everybody, Warren Buffett. Remember when he was asked, I love this one, when you have his money, you get to tell the question. So the question was, Warren, what have you been buying lately? Oh, I've been buying railroads. Well, that's a true statement. He was buying railroads for 2 years. And guess what he's doing tomorrow? What do you think he's doing tomorrow? After he makes a comment on national television, he's been buying railroads. What do you think he's doing tomorrow? Yeah, and he did, absolutely positively selling them, right? Nice little bump from the public saying, I want to be like Warren. Everybody buys railroads, they buy the top. Thank you. Now, there's a fine line difference here, and I even have a little trouble phrasing this. It's borderline acceptable to maybe ask about one's thought process when you are learning. And here's the line I want you to remember. If you're learning, you, everyone, myself, you will eventually become a trader that is the sum total of all that you have learned from your mentor, from others, from reading, from your experiences, and how you interpret and file them internally. Does that make sense, everyone? Even if you have a single mentor, right? I think several people that are in the DTS seminar program, I think several of them would say, I am their mentor, period. But they're not going to be carbon copies of me. They're going to have their own experiences. They have their past they've gone through. They've had maybe some, and you know, when you read something, you're not going to learn to trade from reading, but what you can do is you can pick up a nugget that sticks with you, right? You're going to pick up a nugget that sticks with you here. And I told you my favorite quote, the Jimmy Rogers quote. It was an accidental read I did my first year trading. It was in the preface to another book I was reading, and that stuck with me, you know, and that affected me to some degree. So you become the sum total of all these things. You're going to be always unique like a fingerprint, but the basic structure you have, you should try and emulate a style that you like. The worst thing you can do is to try and learn from 6 different people because you're never going to understand any one of them. However, saying that, I don't think it's bad to try and get a thought process from somebody. Maybe it's to validate the way you think. Maybe it's to help you understand the way you think. So you say to somebody, and I mean, whether you just know them in a chat room or, you know, somebody you just know because they're a friend of yours, whatever, and maybe you see a trade that said, hey, explain to me, that looks like you just bought a downtrend. You know, what am I missing? It worked for you. What did I miss? And maybe they say something to you that clicks with you and you go, oh, okay. So you see the fine line I mean? I think it's stupid to ask opinions about stocks, the market, when we're bought, and that kind of stuff. But to say to somebody, hey, what you just did there, explain to me what you did. Not that you're necessarily going to copy that or take it, but that maybe you can work it into what you're learning and understand from it, right? Put it in, digest it, and then spit it out. Wow, how obvious and educational. I think that's a serious comment. If it is, thank you, RC. Let me read it again. You will eventually become a trader that is the sum total of all you've learned from your mentor, others, reading, experience, and how you interpret them and file them internally, okay? The best thing to pick is to pick a mentor and learn their style. You can adapt and change things to fit you, but you can't learn 5 different styles. Any questions on this one? If you tuned in late, I sent an email out saying some of you may consider this one of the more boring presentations. I get it. I try to warn you. I said it wasn't going to be thrilling. But if I can help 3 or 4 of you avoid some of the stuff I'm teaching, I think it's worth it. And maybe it'll be more than that. Because I'm on the last topic here. 5:45. We're on the last topic here. And this to me is, I think, a particularly big one in a way, in that it gets some lip service, but I don't think it really gets the lip service that it gets lip service, but I'm not sure people fully comprehend how important it is. Boring stuff usually. Yeah, thanks, Mark. It is actually. Yeah. Oh, good. I'm glad you guys, do not. But I try and give you fair warning. I know it's not, a lot of people. It's like, oh, gee, nice, all these charts and how you did this and how you did that. The last, don't do this is simply titled over trading, and I cannot overemphasize this one enough. And I think there are people that might argue with me to some degree. And I will say, like I say with some of these topics, they would just be wrong. I'll get on a podium, we'll have a public debate, and they'll walk away with their tail wagging between their legs. Maybe some of it's semantics. What about if you have a hot hand? I think I get your question. Well, number one, when you have a hot hand, you don't change your share size, don't change your risk amount. You wait until you do that structurally through another process. And there's nothing wrong with continuing to trade. I'm not saying, let me run through it and then see if you have a question, Lope, okay? Because there's nothing wrong with doing that. The issue is when you don't have the odds. See, here's the whole thing. There are times when you have the best odds. After that, you're compromised. That's the whole bottom and top line right there, right? There are times now, when do you have the best odds? Well, that's different for everybody. I mean, that's just how you look at things. We had in the room yesterday, one of the good traders in the room took Macy's. And then at some point at the high said, you know what? Short, I still know the numbers, 20, 21, 20, 21, 40. And I didn't do the trade. Just a suggestion. And that would have made just as much money on the way down. So was it right to take it on the way up or take it? They're both right. It's how you look at the day. It's what you did that day. Sometimes it's a little bit of luck, whatever it is. But the point is that the way you trade, the style you have, whatever it is you do, you have a prime time, a prime setup, a prime focus. And that's what you should focus on. And every time you click one notch away from that perfect thing, and you do have to click, you're not always going to have perfection, right? You can't sit there and wait 18 months to get the setup you want. You have to click away from perfection, but there's a range that you do. And just remember, every time you click a notch away from what you want, you're decreasing the odds. So you're somewhat compromised. And what you have to be just ever so careful of is that you do not continue trading when you're not doing well because you don't have your setups. Now, if things are going well, if you have your odds and things are clicking along, continue to do what you normally do. That's how you have a good day. That's how you make a whole week plus in one single day. I do that fairly frequently. But the key is that when you are not clicking right, don't go try and make a small winning day into a winner and keep trying and trying. And you have the trade, if the trade is what you're supposed to do, and that trade's going to bring you back, great. But don't start lowering your standards to erase the red on the screen. Does that make sense? And by the way, Lope, for what you just said, there's only two times in psychology comes in and messes with you. Only two, and that's a good thing. There's only two times it hurts you. One is when you're winning because you think you're God, right, Lope? You think you're the trading God and you start lowering your standards because you think anything will make money and then you give it back very quickly, right? And the only other time you have problems with psychology is when you're losing because now you have to erase that red on the screen, right? Let me give you a stat, and I've mentioned this before, but this may blow you away. In a prior life, one of the things I did for a period of time was I helped monitor some prop trading accounts. Okay, so these are people that are like, working with a company account and they're prop trading. So we had access to see their accounts because they're our accounts, you know what I mean? And there was a period of time, you ready for this? That at 10 o'clock, now I'm not saying 90% of the traders are green at 10 o'clock. What I'm saying is, if you looked at 10 o'clock and said, who was green? Who was making money at 10 o'clock? That there was a period of 6 months that 90% of those people were down at 4 o'clock. Now that should kind of shock you. Let me say that again. At 10 o'clock, if you took everybody who was up money at 10 o'clock over a 6-month period of time and then watched them, 90% of those people gave all their money back and then some by 4 o'clock. What does that tell you? What does that tell you? Yes, over trading, right? Because you simply, I mean, in my, now I got to be careful with this because in my world, there's just a limited time that you're at your best odds, and then it fades based on time of day, based on the charts you're looking at. Now, one of the things is that I kind of focus strategically on 15-minute, 60-minute charts as a day trader, which means there are less total setups available to me than if you're a 2-minute trader, right? If you're a 2-minute trader, you're going to have many more opportunities. But nevertheless, that 2-minute chart still exists inside of bigger time frames, and its reliability is based on the bigger time frames, correct? Yeah, and because also I'm not saying you're nicer. I'm not saying that you have to quit after 30 minutes or 60 or 90. What I'm saying is that you should have a limited time on the screen. Now, right here, we're kind of at this right this second. I'm talking about day trading. Right? I'm talking about 30 minutes in front of the screen. I tried to focus 90 minutes, and I think nobody should be in front of the screen more than 90 minutes, not 90 more continuous minutes. Maybe you come back for 30 minutes later or something like that, but you just don't have the odds throughout that period of time. There's days where you just don't know where things are going, and you don't want to sit there trying to figure it out. There's days that kind of match what you expect to happen. You hit the right moments, you hit it hard, you walk away, you leave it. But you can't continue to have those odds for the rest of it. Just the simplest concept, just the simplest thing. The market's in some kind of downtrend, whatever. Boom, boom, right? We close the day. The next day we open, we rally back. There's the high of the day at 10 o'clock, boom, and we fall, and then we start falling. Well, this is your prime. That's prime time for me, right? And that's where you get in and you take a little money and you hold some in case you do this, right? But a lot of times you just don't know. If you start saying, well, I'm going to sit here all day, oh, I'm going to start shorting this, this, and this, well, how do you know you're not going to do this? And even up here, how do you know you're not going to do this? I mean, the variables as the day go on increase, and you just have to be sure that you are hitting it at the time that you understand the best. The setups, the time, it's all individual. I'm not saying there's any right or wrong time. What I am saying is that for everyone there is a prime time, and that's what you have to focus on, and not continue to sit there and think that you're going to make. It's not like working at McDonald's, and the more hours you put in, the more money you make. It's not like that. This is one of these things where oftentimes the lazier you are, the better you do, as long as you know what you're doing. And the final comment on this is that there are always times that you will be off. Sometimes you get it wrong. Trading is about odds. Today, I had it wrong. Came out okay, because I lost today, but I only lost a couple, and I had pretty much nothing right today. One of those days. Some days you have it right and you just miss it. This is my story for a lot of the last couple of weeks. Had it right, had the right stuff on the screen. I've been a little hesitant. Let me explain to you why too, especially if I am writing about this. I'm going to send this to everyone. But for the last, long-term has been great. Long-term account doing great, up through and including today. Day trading the last 4 or 5 weeks, I've been even. I've been just break even, which you may say break even. It was a good year up till then. I had a great June, fantastic June. And then I got in this little thing where when is break even good? When is break even good? Ironically, Steve, yeah, you coincide almost perfectly. Steve started in the room the day I started going break even. I actually thought about that one day. But when is break even good? When is break even great? Yeah, when the alternative is being down. You ever had a really bad streak? I'm sure you all have. You ever had a bad streak where you really had a bad month or something? And you look back and you said, man, I wish I would have just taken it easy, right? Well, that's kind of the attitude I've had. I've had a big fear of not wanting to dig any kind of holes. There's been a lot of trades that I've passed that actually were great. Right, Zach? I've had 6, 7, 8 trades in the last 2, 3 weeks on the long side I didn't take, including today, that were great because I've just been a little laid back. I've just been sitting here, and I think it's one of those, there's these spirals when you trade, upward spiral, downward spiral. And if I would have had like the week's goal under my belt by Wednesday, I would have said, take this trade. I would have been a little more lax. But sitting there break even on Wednesday, you're like, you know what? I don't want to, I'm just going to wait for the best thing that I can see. So there's sometimes where, and that's just number 2, where you have it right, but you just miss it. You're just a little hesitant, whatever it is, and that's not good. But when the alternative is when you don't feel you have it to lay low a little bit, there's nothing wrong with that. You can make it up easily. I'm very comfortable with everything. Sometimes it's tough for me running a room, but I'm very, very comfortable with that. Let me say some of those, Zach, I don't agree with. I don't agree with. And maybe it's semantics again. You said choppy market. The market is never an excuse. The setups are never an excuse. You've never heard me use that as an excuse, have you? You've never heard me say, well, guys, yeah, I was break even today, but the market was impossible. No, never say that. It's our job. The market is what it is. It's to understand the market. And by market, I mean the stocks, the setups, whatever you're trading, is to understand your trading, understand when it's up, when it's down, when it's neutral, when it's sideways. And the better you are, the better you understand it. And it's also part of our job to say, you know what? Don't quite get what's going on here and to lay low. That's part of our job also. Now, some days, maybe semantics here, you can say, well, the reason I didn't do well was because the market wasn't what I thought it was. And in my mind, there's a huge difference, right? There's a huge difference between saying, oh, well, nobody can get to them. Of course, it's our job to get it right. And on any given day, you talk to one trader, oh, it's an easy market today. Talk to another trader, oh, it's a difficult market today. Well, it all just reflects around whether you got the right trades or not. I don't think there is a difficult market. Now, sure, when it gets kind of choppy, I think today was exceptionally choppy. I have to know and I have to understand that as a trader. I don't blame the market, but today the reason I got it wrong was because I didn't read that right, for whatever that's worth. Some people got some trades right. Some people made money today. That's great. Tomorrow they may be flat on their back and I'm going to do great. So back to the slide, some days you have it right and you just miss it. Sometimes there's luck. As much as we don't want pennies to matter, you can't escape the fact that sometimes they do. One of the biggest things in my trading is that I teach is to trade with hand grenades and not BB guns. And what does that mean? It means I don't ever want pennies to make a difference. But no matter how much you try and avoid it, no matter what you do, there has to be some moment where you hit the button. And you could go along and get sucked in by one penny. Happened to me twice in the last 2 weeks. Get sucked in by one penny, and then the trade goes the wrong way. Sorry, folks, there's some luck there. I don't care how good you are, what systems you have, I do everything I can to prevent that, more than probably any trader on the planet. But yet, right, I don't think you're going to disagree with that. Sometimes, no matter when you decide to get out of a trade, you get out at the one penny low. It just happens sometimes. And sometimes the luck goes against you. So the point of it is that you stick to what you do. You know what you're doing. If things just aren't right that day, whatever, and this applies for long term as well too. There are times you have to make a decision. You know, do I kind of flip here to more of a long bias? Do I decide to just sit and wait for the right setups? Do I wait for particular stocks to set up perfectly? You have to make those decisions, but there's times where there are lower odds than other times. That's it, right? Well, Chris, funny you should mention that. Look what Chris just said. Sometimes I think we have to always understand the market. No, Zach, that's just it. You don't have to understand the market perfectly, and that is along the next slide I'm going to show you is going to be amazing because Chris has said this discussion leads me to sense psychology is as important as technical training and setups. And look what the next slide is, I think. Oh, well, here's the next slide. I'll come back to that because I couldn't stop my momentum there. There's a presentation about this, what I call the three-legged stool. Superior technical understanding, math and probability, psychology and or experience. You have to have them all. And what I always say about a lot of traders is that they're having a hard time and maybe they're at an 80% level on their chart reading, which is good, should be making money. But they don't understand this and they don't understand this at all. And what do they do to get better? Well, they try and bring 80% up to 90%, right? You know what I mean? But they're not doing anything about this. This is a very equal stool. And I think you can get by without a fair amount of superior technical understanding if you really get the other two. Because trading is really not that hard. Sometimes we make it hard. Back to the last slide on overtrading. Here's the summary for overtrading. Overtrading can make the difference between a less profitable or break-even period of time and a big loss time. Big losses start downward spirals that are hard to overcome. They must be avoided. So remember, there's days where it's like fish in a barrel, and I think everybody has those days or will have those days as you get a little experience. Those are the days you appreciate, you take your money, and then when it's not fish in a barrel, don't go crazy. Understand you may have a loss or two, but don't dig a hole and don't worry about it. A lot of that comes down to confidence, to knowing that hey, when it's right, you're gonna make a killing. Amen. That should end the whole thing. So I'm gonna leave it on this slide right here. This is in the on the free stuff page, and this is actually right in the Hall of Fame section. So you don't have to go find it. If you haven't seen this one, go view it. I think it's one of my faves. I picked it for kind of the fave tonight to go watch. And remember, if you're on the free stuff page, there is a whole archive section. Only the most recent videos are on the free stuff page. At the top of each section, you can go to the archive page and get all the videos going back to the beginning of time at DTS. Are there any questions? It's 6:02. I'm going to have a couple of educational emails coming out. I took some time off last weekend. I was going to do some, but I didn't do them. So over this weekend, there'll probably be a couple of educational emails coming out. Any questions, comments, anything you guys want to talk about? You've been a great crowd. All right. Have a good night, everybody. And if you're in the room, we'll see you in the room tomorrow. Take care.